Gold just crossed $5,000 an ounce. For context, it was sitting at $2,000 just a few years ago. That is a 150% gain, and it happened while most people were watching everything else. In a single year, from early 2025 to now, gold is up over 74%. That makes it the best performing major asset class on the planet. Better than stocks, better than real estate, better than crypto. And the people who positioned for it years ago? They were called conspiracy theorists, doomsayers, out of touch with how modern markets work. They were right. And the question you need to answer right now is not whether gold already ran. It is whether you understand what drove it, what it is telling you about the state of the global financial system, and what comes next. In this video, I am going to break down all three of those things. The real drivers behind this move, not the surface-level explanations. What history says happens after a run like this, and the practical steps you can take right now with your own money. Let's get into it. To understand why $5,000 is so significant, you need to understand where gold has been. In 1971, President Nixon ended the gold standard, untethering the dollar from gold entirely and allowing gold to trade freely in open markets. Before that moment, gold was fixed at $35 an ounce. After it, gold was whatever the world decided it was worth. By 1980, gold had surged to $850 during a period of runaway inflation and geopolitical panic. Then it spent the next 2 decades largely ignored, sitting around $250 by the year 2000. Then the dot-com collapse, September 11th, and the uncertainty of the early 2000s pushed it back up. By 2011, it hit $1,900, a record at the time, before pulling back as markets stabilized. Then came 2020, a global pandemic, the largest money-printing operation in modern history, supply chain collapse, and the beginning of a new geopolitical era. Gold crossed $2,000. Then it kept going. 2,500, 3,000 for the first time ever in March of 2025, 4,000 by October of the same year, and now 5,000. That trajectory is not random. It follows a very specific and identifiable logic, and once you understand that logic, what comes next becomes significantly clearer. Driver 1. Global uncertainty, hit levels not seen in decades. The single biggest driver of this gold move, backed by hard data, is the explosion in global economic uncertainty. Researchers at EconoFact found that the spike in the Global Uncertainty Index accounted for nearly half of gold's price rise over the past year. And this was not vague, general anxiety. It was specific. Trade policy uncertainty surged after November 2024, with tariff threats against the United States' largest trading partners creating a kind of economic fog that investors had not experienced in generations. When nobody knows the rules of global trade next quarter, when nobody can predict policy, when the economic framework that businesses and governments have relied on for decades suddenly feels unstable, money flows to the one asset that has stored value through every crisis in human history. Gold. Driver 2. Central banks went on a buying spree. Central banks around the world, particularly in China, India, Turkey, and across the Middle East, have been buying gold at a pace not seen since the 1970s. According to the World Gold Council, central banks purchased nearly 1,000 tons of gold in just the second half of 2024 and first half of 2025 combined. And their share of total gold demand has risen from about 12% in the years before 2020 to nearly 25% today. Why? Because after Western governments froze Russian foreign exchange reserves following the Ukraine conflict, every government, not tightly aligned with the United States, received an unmistakable message. Assets held in dollar-denominated instruments within the Western financial system can be taken away. Gold held physically in your own country cannot. Central banks do not announce these strategic shifts loudly. They just quietly accumulate. And the weight of that buying is one of the most powerful forces that has moved the price. Driver 3. The dollar is under real pressure. Gold and the dollar have a well-established inverse relationship. When the dollar weakens, gold becomes less expensive for buyers around the world in their own currencies, and demand rises. The dollar has been under genuine pressure from multiple directions. The Federal Reserve cut interest rates 3 times in 2024 and again in September 2025, reducing the yield advantage that dollar-denominated assets historically enjoyed over non-yielding gold. And beyond interest rates, the dollar's long-term credibility as the world's reserve currency is facing a structural challenge. De-dollarization. Countries quietly reducing their reliance on the dollar for international trade and reserves has been accelerating. It is not a sudden collapse. It is a slow drift. But slow drifts in trillion-dollar reserve systems show up unmistakably in the gold price over time. Driver 4. Investor FOMO and ETF inflows poured in. Once gold crossed $3,000, something shifted in market psychology. JP Morgan reported that in the third quarter of 2025 alone, investor demand, through ETFs, futures, and physical bars and coins, plus central bank buying, totaled around 980 tons. That was over 50% higher than the average of the previous 4 quarters. ETF inflows surged as institutional investors who had been underweight gold for years started rebalancing. And as the price kept climbing, retail investors joined in, not always with a clear thesis, but with the very human fear of missing what looked like a historic move. When institutional rebalancing and retail momentum hit in the same direction at the same time, prices can move faster and further than almost any model predicts. That is part of what happened on the way to 5,000. Let that sink in for a moment. To find a year where gold performed comparably to what we just saw, you have to go back to 1979, the year before Ronald Reagan became president, the year of the Iranian hostage crisis, the Soviet invasion of Afghanistan, oil at $40 a barrel, and inflation running above 13%. Gold gained over 70% that year, on its way to the $850 peak. The parallels to today are not perfect. They never are. But the conditions that drove gold in 1979 and the conditions driving it now share a striking number of features. Geopolitical upheaval, inflation that proved more stubborn than central banks expected, a weakening dollar, a loss of confidence in government's ability to manage the economic environment, and a flood of money into the one asset that has stored value across every civilization, every currency collapse, and every geopolitical rupture in recorded human history. Gold at $5,000 is not just a number on a chart, it is a referendum, a global vote of no confidence in the current state of the monetary and geopolitical order, and it is worth taking seriously. Now here is the part that requires the most honesty. What does history say happens after a move of this magnitude? Because gold has done this before, and the aftermath is not always what people expect. After the 1980 peak at $850, gold spent the next 20 years below that level. 2 full decades. After the 2011 peak at $1,900, gold pulled back to around $1,100 before recovering. Parabolic moves do not go in one direction forever. That is true of every asset in every market in history. Anyone who tells you gold can only go up from here is not giving you the full picture. However, and this is the critical distinction that separates a thoughtful analysis from a headline, the conditions that resolved those previous peaks are not clearly present today. In 1980, Paul Volcker raised interest rates to 20% and crushed inflation. The conditions that drove gold reversed hard and fast. After 2011, relative monetary stability returned and the fear trade unwound. Today, the uncertainty driving gold is not obviously temporary. The debt levels are structural. The geopolitical fracturing is structural. The de-dollarization trend is structural. JP Morgan's own research forecasts gold continuing toward $5,000 per ounce by year-end 2026, and some longer-range forecasts project even higher levels in 2027 and beyond. That does not mean they are right, but it does mean that serious institutional analysts see the conditions as intact, not exhausted. The honest answer, the one you deserve, is that nobody knows where gold goes next month. But the forces driving this move are real, documented, and not yet resolved. That is the framework you should be thinking inside of. Before this section, I want to be completely clear. This is not financial advice. I am not your advisor. What I am going to do is explain the different approaches investors are taking and the logic behind each one, so you can make an informed decision based on your own situation, goals, and risk tolerance. Investors who already hold significant gold are largely not selling their entire position. Many are trimming, taking some profit off the table on the portion that has grown to represent an outsized share of their portfolio. If gold was 5% of your portfolio at $2,000 an ounce, and it is now 15% at $5,000, standard portfolio management suggests rebalancing, not because you are bearish on gold, but because concentration risk is concentration risk, regardless of what the asset is. Now, I want to hear from you. Do you own gold right now? Are you buying more, holding, or taking some profit off the table? Drop your answer in the comments. I read every one, and on a topic like this, the conversation in the comments is genuinely as valuable as the video. If this gave you a clearer picture of what is actually happening, hit the like button. It helps this video reach more people trying to make sense of this moment. Subscribe, because what comes after $5,000 matters just as much as what caused it, and I will be covering it. I will see you in the next one.